Hi, I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today on the EIA show, we're going to have a lot to talk about. We had Henry come through and hit a key part of Louisiana. We had the OPEC Plus meeting that just wrapped up today. Luckily, it was a summer Friday type one, which was good because there wasn't too much to change. But we really want to go through some of these adjustments that we've seen and what do we think is going to happen going forward, because Henry's going to instill a lot of noise in some of the data and some of the numbers right now. And when we look at just what has happened so far, so this was a quick estimate, and then we'll have the firm numbers of what was lost on the refining side. So we'll talk about the refining side, which lost a little over about close to 2.2 million barrels a day of throughput, obviously on pad 3. But the biggest issue right now is not so much the damage to the facility, because so far the damage looks fairly minimal. It's getting power back to the facilities, getting people back to the facilities. You know, a lot of these roads are either still underwater, covered with debris. And then the human element, these individuals are also facing, you know, how are their homes? How are their family members? So there's a lot to process here in terms of where this is going to go. Now, typically refiners take longer to come back than the production. So we're going to have to look at what is happening on the production side, because a key port that pretty much maintains about 90% of the bringing food, individuals, to and from the facilities, took a direct hit, which that is now going to create, can they get some of the supplies? Can the people from different ports, because Houston was unscathed. So there's a certain amount that can be transitioned from one to the other. But again, it's just going to take time to do that. All of the facilities were there, the boats were there, the equipment was there to do this. So there's going to be a push to get some of that offshore production back. But typically it takes 72 hours after the storm passes to get a lot of those facilities back up and running. But due to some of those issues at the port, that might delay things a little bit longer. So we'll get production that's going to come down and stay down a bit longer than normal, but then when you look at the loss of refining capacity, it should marry up, not 100%, but it should get a little bit closer given what we've seen so far. So just to put it into context, so about 2.1 million barrels a day of refining capacity, closer to 2.2 million. It's about 12% of total U.S. refining capacity. But then on the other side, we did have Pemex restart the 421,000 barrels a day that was offline that we talked about on Friday. So that's now come back. So that'll help insulate some of that capacity, because when you look at what comes out of the Gulf of Mexico, you typically have that heavier, the heavy sour or the heavier sweet. So Pemex coming back can help offset that a bit. And then, so right now, when you look at where things are, the U.S. Gulf of Mexico operators shut in about 1.7 million barrels a day. So 2.2 million of refining lost, 1.7 or so of production. So you can see that that disconnect. So we will have some of that come back through. And then there's 2.1 MMCF a day of gas, or 94.5%. So those are going to be some things to watch, especially when we start talking about the weather estimates for going into winter, and why that's good for gas, natural gas. But then when we look at Colonial Pipeline, so Colonial Pipeline was able to restart both lines 1 and 2 as of Monday night. So in terms of the impacts to the north, it's pretty much minimal at best. Or if anything, really. The biggest issue is going to be we're going to start seeing bigger draws in gasoline at this point, because we're not going to have the refining capacity. So we will see gasoline draws accelerate. We will start to see some builds in crude. So right now we had a big draw in crude, seasonally speaking, a big build in gasoline. that will reverse, and we'll get a build in crude and then a draw in gasoline, and then the draws in gasoline should continue as these refiners get reopened. As long as there's no real damage, it's just going to be a matter of when can they get power back to the facilities. So now that we've started to get a little bit closer to the actual number, you can see some of it has actually increased. We're up to about 2.4 million barrels a day that's offline. That will start to reverse because you'll have some facilities that will pick up to make up for what was lost there, try to take advantage of it, not in a mean way, just in terms of just the math behind it. So right now, Port Fortune was the one that services about 90% of the deep water U.S. Gulf. So that's going to be the biggest issue, because Louisiana Highway 1 has to be cleared in order to get to and to then assess and adjust. But based on what we've seen so far, even though that specific port got hit, some of the other ports within the region actually fared much better. So there could be a chance that instead of having to go to Houston or come out of the Texas area, we might be able to move some of this capacity into some of the other ports. But again, that's going to take time, things that will have to be assessed. Now, before we continue on this trend, and we'll touch on it more in segment 3, but we had OPEC essentially is going to keep increases the same. They're going to increase 400,000 barrels a day. That was, again, very much expected. October 4th is now the next OPEC meeting. So that's when we think they'll start to get a little bit more concerned about where supply is versus demand. The JMMC is coming out with some of the things that we've been seeing in terms of 2022 estimates into 2023. So we could start to see some talk about, well, should we pause the cuts? Should we not increase as much? And given if demand gets worse and if things get worse, the October 4th could become earlier, and they may come up with an agreement to maybe not increase as much as expected, which is, again, that 400,000 barrels a day. So when we look at the unit types, you can see just where the outages are. Obviously, it's on pad 3. When you look at the daily, again, that 2.3. So we did have some of it come back. It's going to obviously be a moving target at this point, but it gives you an idea of what some of those impacts were. Now, when you look at what the issues are, you have to look at, and this is just showing Monday, Tuesday, Wednesday. That chart is showing you the amount of people that still don't have power. So as long as they don't have power, you're going to get an idea that you need stability, because you can't bring something back online, especially a refiner, and then have the power get cut. Because for those that have been through hurricanes, that have been through storms, sometimes you'll all of a sudden get power cut off, not because your power should be cut off, but they have to take everything down to fix some other areas, to run new lines, put up new telephone poles. So again, these are going to be things that are going to have to watch. Now, when we start marrying what's happened here with OPEC, so the expectations, so the OECD commercial oil inventories at the end of 2022 are expected to be 146 million barrels above the 2015-2019 average in the first scenario, and 495 million barrels above in the second. Given what are some of the breakdowns that we've seen, as Anas has said on Twitter. So when you look at just what that backdrop is, that doesn't set up well for 2023, which are some of the things that are being considered. And then you still have Russia essentially above or violating the OPEC plus quotas by 103,000 barrels a day. So those are some of the things that are going to continue to be worked on and looked at as we go forward. So then when you look at the head of, when we talked about Libya on Friday, the biggest issue right now is there's some friction within Libya in terms of, money, who's getting the capital to continue production. So that puts anywhere between 250 and 300,000 barrels a day at risk. Right now, there's been a lot of threats, but nothing has been followed through. So that's going to be something to watch as well when we start looking at what's going to go forward. So when we look at the numbers today, we had the draw of over 7 million barrels We had a build of about 1.2 million barrels of gasoline. That's going to be something to watch. And when we look at what happened on the implied demand, our expectation was gasoline demand was going to drop. We were going to get a spike in distillate and jet fuel demand. And instead, because of a lot of the things that we've seen with, essentially refiners and the system pulling forward for the, let's call it the last hurrah of Labor Day, you had a lot of support in the gasoline numbers, even though when we look at Gas Buddy data and we look at DOT data and then we look at Descartes data, we're actually much closer to what we were expecting of about 9.1 million barrels a day. So it just means that as we get to the other side of Henry, as we get to the other side of Labor Day, we're going to get that big drop down. And now instead of being that drop in distillate and jet, we're going to get a big drop across all three, which again will put us back in line with that 4-week average, which is why we always like to look at the actual number, what is the weekly number, but then also what is the 4-week rolling average, because you'll start to smooth that out a bit and you'll see some of those differences as we go forward. So when we look at oil inventories, you can see we're following the 2019 trend. We're still above where we were in 2018, 2019, and 2015. But you can see, again, seasonally speaking, we're very much in a normal level, even though we had that 7 million barrel a day, a 7 million barrel drop. It's just something to put in perspective when we're looking at where some of these things are in general and where some of the capacity is going to be over that time period. So when we look at oil inventories, when you look at refiners typically need, depending on the impacts, anywhere from 10 days to a month to get back to normal. And right now, the early estimates is that we're going to see about 3 weeks to get back to that normalcy. But when you look at the 3 weeks, that puts you into the end of September, where we normally have refiners coming down, just for seasonal maintenance. So even though the refiners may be fixed, they may take this opportunity to say, hey, while we're down, let's do some maintenance. Let's keep things down. And that'll, again, minimize. So we're not going to get back to where we were. We'll just see this kind of bleed right into that peak downtime for shoulder season and maintenance. So then when we look at days of supply, you can see that we're still well above average. We're still at 27 days, above 2017, and the only times that we're higher were 2016 and 2020. So then when we look at commercial stocks factoring in crude, gasoline, distillate, residual fuel, and jet fuel, you can see that we're right in line with 2016. We just dipped below 2015, but again, we're still well along the normal, let's call it, seasonal path when you look at what happened in 2017, what happened in 2019. Again, something very similar, even though we did have that large drop in crude. We did get a drop in distillate, but we also did get a build in gasoline, which we'll talk about more in segment 2. So then when you look at gasoline, here's that increase that we saw overall. When we look at the underlying number of build of about 1.29 or 1.3 million barrels, you can see we're now back above 2017. We're still sitting sideways. Now, when we go forward, we're going to start to see that acceleration to the downside when you start looking at the impacts from Harvey, a lot of these other time frames. You can see that there's that big drop going forward. Now, Louisiana being hit versus Houston, you still have a lot of refiners, and where Henry hit, even though it wasn't as wide, where it hit was essentially impacts where most of those Louisiana refiners are. So we will see those stay down, while Houston and Texas in general, we should start to see them ramp up a bit to take advantage of some of that downtime. So we will see draws. It's just it's going to be lead to more refined products pulled down versus more builds in crude. So then when we look at the distillate side, distillate had a drop of 1.7 million barrels. You can see we're still well below normal, especially when you look at the last 5 years. And this is going to be some of those shifts of how are refiners going to manage it. What does that look like? And when you look at what has happened in Louisiana, you have the Loop, or the Louisiana offshore oil port. That's going to be a problem, because right now, when you look at Houston, there's a lot of exports of crude from Houston. and a lot of imports of crude through the loop. So when you have that drop, this is where we're going to have to watch what is going to happen with oil builds, because how long will it take for some of this importing side and to pick back up versus the exports that will remain low. But again, exports remaining elevated while imports remaining low, you're still going to get that nice blend in terms of just what does that mean for storage. And then jet fuel had a nice drop overall. And when we look at jet fuel, we are seeing more demand with jet dropping 2 million. We're getting a lot of demand out of the Pacific Northwest and the West Coast in general, not because demand is up for flying, because it's not, and we'll talk, I should say for commercial jets, as we'll talk about in segment 2, but we are seeing a lot of fire flights used to try to keep some of these wildfires under control. And that's something that is pulling some from Pad 5, but again, we'll go through that in more detail in segment 2. So when we look at the curve, you can see that in general, we're still pretty much right in line with where we were the other day. Not too much has changed, given OPEC was, again, right in our base case, and I think a lot of people's base case scenarios. Henry came through and did, I think, what a lot of people were expecting. At the outset, the question is always going to be how quickly do things come back? But when you look at OPEC, what does that mean going forward? You can see that there's been pressure put into the curve as you go through the end of it, as it keeps moving lower. But again, it's not predictive. It's just a matter of where things set out right now. So that's going to be something to watch to see how does that impact some investments, offshore, onshore. So that's going to be something that we'll have to look at. And then when we look at COVID changes in cases, so we had the U.S. data dump for the weekend. So we had that pickup. Again, things have still rolled over. So it's going to be a matter of how quickly do they drop, or is it going to be something similar to the U.K. where you see this kind of stability at this plateau level? That's going to be something to watch. So far, it doesn't look like that. So far, we've had a fairly steady drop, and that's going to be something to watch going forward. India, something very stable, where when you look at the Asia Pacific, you're starting to get a little bit of a drop, but you're still within a margin of error. And Malaysia is still elevated. Japan's starting to roll over a bit. Thailand starting to roll over a bit, while Vietnam and South Korea still remain elevated. So again, there's still a lot of pressure in the Asian markets, which is when we start talking about demand and what does that mean for demand in general. That's going to be something to watch. So then when we look at crude stocks, so crude obviously dropped 7.17 million barrels. That's 44.1 million below the 5-year average. But when you look at where that drop was, you can see there were builds across the board, except in Pad 3, where Pad 3 had a draw of 8.97 million, which now takes us 6.7 million below the 5-year average. So when you look at the EIA on the production side, you can see production's at 11.5 million. So now they're back to where we said we've been, but at the same time, you're also looking at those timing delays. So even though we recorded the drop from Henry, the EIA didn't record the drop in production. So the production will likely come in next week, and remember it's going to be on Thursday because of Labor Day on Monday, will likely come in anywhere between 10 to 10.3 million barrels a day, depending on when do they see or when is some of this recorded, because at the same time, we could have some more production come back prior to when you have to file with the EIA. So again, there's going to be a lot of timing delays, a lot of noise, which is going to be something to watch. But when you look at Cushing had a small build of 840,000, well below what the API was saying. But again, one of the things that we've been talking about is that the builds weren't going to be these huge surges in Cushing. It was going to be a steady increase of, and this is what we've been talking about, is the pace is still going to be slow of those builds into Cushing. 840,000 barrels is very, nothing, not the 2 million that API had said. So there's still 13.4 million below the 5-year average in Cushing, but It's going to be something when we look at how quickly does pad 3 see some of those increases, and that's where we should start to see some of those builds, as pad 5 did take in more imports, and that's going to be something to consider when we look at West Coast and what is that flow going to look like. So then when we look at land storage, so land storage had a drop, especially when you look at the global footprint. We had another drop in Europe, which is going to be a positive. We had another drop in the US, which is a positive. But then when you look at east of Suez, we continue to see some builds. And one of the things that we're going to talk about is, even though this is looking at land storage, offshore storage continues to go up in Asia because there's those problems at the port side. There are those significant delays, and that is creating some of these hindrances when we look at getting crude from offshore to onshore, which is making some of these numbers look a little bit better. But we have to look at what is going to come, especially when we start considering Asia and West Africa. So then when we look at just talking to the storage, you can see storage still remains elevated on a global level. So even though we've had onshore drops, we still have an elevated offshore, well above the 5-year average and just sitting sideways. So again, there's going to be that offshore to onshore move, which is really going to help supplement and build up what some of these draws look like, because you have to look at both of them together to get the full picture of what is onshore storage, what is offshore storage, what is the how far are we above what the average is, regardless of what average you want to speak about. And then one of the other issues that we continue to see is the majority of Nigeria's October cargoes have yet to find buyers, with many shipments sold to date being reoffers. So right now, we're seeing things move at a very slow pace. But then when you look at Angola's been at a little bit of a quicker pace versus the last month. So again, there's this caveat of what does West Africa look like when you're considering west of Suez, where we think West Africa is going to continue to be elevated. The Middle East is going to continue to push up, but we'll talk about that more in segment 3. So then when we look at activity, China is back to about 90%. That's something that we think is going to stay. The PMI data came out yesterday for China. It was exactly what we have been talking about, those slowdowns, where we saw rampant slowdowns, even contraction in some areas. But September is going to be a little bit better, because at the end of August, things started to improve, as you can see clearly in this chart, and that's going to provide some bump into the PMI data, while we're seeing America start to flatten out along those seasonal levels. Again, the Americas coming back to the seasonality that doesn't really match up with that implied demand, with the rest of Asia starting to recover, and Europe again coming back to that seasonal norm. But we'll talk about that more in segment 2. So then when we look at pad 3, you can see that nice little drop here. We're now below 2017, which had that big bump. So we're still well within, I think, normal levels. Obviously, 2020 took us to skewed that average to the upside. But you can see we're still very fluid, very comfortable in terms of where we are versus historics. So the question is going to be, how quickly does that crude come back? How quickly does the import market recover in terms of the loop? And then where does the export market sit? Because that's going to dictate, do we continue to see not so much draws, but just go sideways, or do we start to see a big increase or a big pop in some of this storage? And the expectations we have is that we're going to start to see some of those increases in storage in pad 3. Here's that, we kind of turned the corner on Cushing. Here you can see that kind of steadiness coming back up. We're still below that 15-year average, which is that, let's call it salmon line. That salmon line there in terms of where we are, and what we should continue to see that move back up in a very steady pace, nothing surprising one way or the other. That again is going to see some of that come back through the system. So then when we look at imports were up 185,000 barrels a day. You can see pad 3 had a drop of 506,000. That will remain depressed. It'll come down to when does the loop come back? When does some of these repairs come through? But we did get a big spike in pad 5, as we said we were going to get last week, of 515,000 barrels a day. That will come down a bit, still remain elevated, so we're not going to come back to 975. It'll still be elevated. It'll just be below where we were in this past week, just given those timing delays. And then we did get a big spike in pad 2. We were expecting it to be a little bit less in pad 2. Obviously, it came through. It's tough to get a handle on the total amount. So we try to get some of those estimates. So again, we'll still see pad 2 imports remain elevated, especially against the 5-year, which is 258,000 barrels a day, again, above the 5-year. It'll still say higher, but again, it's just going to be a matter of timing as to when do we see some of those normalcies. Then when we look at Europe, European imports of clean petroleum products were from East Asia set at their highest since May. This month, or this month being August, that's going to continue when we look at into September. And then when we look at U.S. imports of gasoline from Europe, it rose for the 7 days ending last week. When you look at it, it went from 243,000 barrels a day previously to 349,000, which is the highest since the first week of August. Just based on what we're seeing right now, we see it being very stable at these levels, so nothing too crazy. But still, again, elevated versus where we normally are based on historics. So you have Europe importing product, and then they're still maintaining some exports, which is keeping some of their refiners at a little bit better crack spread. But again, we'll talk about that in segment 3. So then when we look at runs, you can see runs were down 1.1%. But again, it's all about when it reported. So you can see we're at 91.3%. Coming down with some of that seasonal norm, but you can see pad 3 was actually up 207,000 barrels a day. This is clearly going to drop. You will see this come to about 6.6 just based on where we are. So, but it'll be a matter of when does it show up? When do things come back to when do they have to report? So that's where we'll get some of that skew, but we will see this drop to 88, 87% and then stay at that level for the next few weeks, just given, again, maintenance season, some of this bleeding into some of the downtime. Then when we look at implied demand, so implied demand was up 6,000 barrels a day for gasoline, so it's still at that 9.578. The disti had the pop from 4.1 to 4.4, up 286,000 barrels a day. That's something that we were expecting. Jet fuel was higher. We were expecting a move back to about 1.7. Instead, we got much closer to 1.8. So that's, again, something that will reverse down. Residual had a nice increase of 282,000 barrels a day. But then when we look at LPG still remains robust, 231,000 barrels a day of implied demand. That's movement through the system. That's, we have the crop, the harvest. And then we still have strong exports, leaving us at well below the 5-year average, and then even the lowest in the last 5 years on a storage side, supporting pricing, keeping things flowing off the coast. So again, LPG will remain strong. Floating storage went to 0 in the Gulf Coast. Again, this is more semantics than anything else, because you have ships that move out of the way of the storm. So again, storage is a vessel that has been stationary for 7 days. Obviously, nothing is stationary, so everything was moving. So you did get this drop. This will recover back up to just that 5-year average. So then when we look at imports into pad 3, you see the big drop. This will start to recover. It'll come down to repairs, personnel. So it's something that will recover just back to 2021 highs. We don't expect it going back to the 5-year average, but it'll just be a matter of time, which based on what we're hearing, what we're seeing, it should be this week or at the latest the end of next week. But again, this is all going to take time. So we'll see. We could see 1 to 2 weeks of impact from that, while pad 2 continues to be robust, seasonally adjusted all-time high. That's something that, when we look at where we are here, we were expecting it to just go sideways, essentially. Instead, we went back up, which just means that we will get a drop back down, probably something closer to, still above the 5-year average, but again, something back within the top of that cloud. And now rounding out, you can see here, we're seasonally speaking, because when you look at refinery run rates, it's not factoring in what we've seen with Henry. So we're still following the 29-year average. When you start getting some of these refiners coming back, and you'll still be fairly close to where we are normally. It's just some of those run cuts that you can see at the end of, let's call it the middle of September. You see the drop from the middle of September to the beginning of November, end of October. Some of that drop will just be pulled forward because they'll just keep some of those refiners down. So now that we've gone through some of those impacts, let's turn to U.S. refined products and what do we see going forward over the next few weeks.